All right. Today is, what is it? January 12th. The days keep rolling, folks. What's going on here? Next thing you know, we're dead. But anyways, this is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's start by this. It is one thing to talk about the CPI and how to trade the CPI beforehand. Let's say a few days before it takes place, a few weeks before the release, and it's another when you're seeing it right in front of you pre-market and you're strategizing before the bell. Take, for example, what happened today. I was not tweeting, but Discording? I was in Discord as the CPI was going out, and by the way, you might ask, how do I get your Discord, Maverick? The answer is, it's a membership perk. And I know what you're going to say, hey, Maverick, but you're charging too much. What's up with this inflation? Show me which other YouTuber puts money back in your pocket. That's number one. Number two, ask any of your favorite content creators and they'll tell you, YouTube is killing us. The pay is down by more than 50%. And the reason is they want us to do these stupid shorts. All the money's now in shorts because they want to be another TikTok, which is absolute stupidity. And I refuse to participate in this de-evolution of humanity. You got attention problems? Take your fucking Adderall. The show's too long for you? Get the fuck out of here. Go to TikTok. And now that we've lost half of the viewers, let's go over what I said in the morning today in Discord. As the CPI came out, 6.5%, plain vanilla, cooked of course. Everybody knows that inflation is at double digits territory, even with a drop in energy prices. We all know. Just look at rents, groceries, eggs, etc. But it doesn't matter. We play with whatever they feed us. Doesn't matter. They gave us 6.5% plain vanilla. And immediately I got three charts right in front of me. Chart number one, and the most important one, is the dollar. Chart number two is oil, whichever you want, Brent, WTI, doesn't matter. And chart number three, the NASDAQ futures, and I'm watching the action tick by tick. What am I seeing? I'm seeing the dollar flushing down. In other words, the market is saying, oh, this is good news because the Fed is going to do 25 instead of 50. The Fed is going to cut rates. It doesn't matter what the market says. We play with whatever the market feeds us. Even though the market's assumptions are wrong, and they're going to be exposed wrong in the long run, down the road, not right now. We'll talk about that in a minute, but 5:50 Pacific time, about 40 minutes before the bell, I say it is shaping to be an energy lead kind of day. If it is SLB, Schlumberger, doesn't matter what you call it, looks like it is breaking out. And then I'm watching the action in the dollar because it flushed down big, but it became oversold, and I say, just keep in mind, this is 6:01 a.m., about 30 minutes before the bell. Just keep in mind, the Dixie is now oversold on the short-run charts. It will attempt to rebound on the open. If it does and then fails to get 103 as support, that would be the confirmation for the continuation of the rally. And then, what do we see? The dollar rebounding before the bell. 6:20 Pacific time. I say Dixie is rebounding right now. Let's see where it goes before reversing. If it does below 103, we rally led by energy. Above 103, and down we go. Now mind you, when we look at the Dixie's chart, if you're looking at the 1 minute, 3 minutes, that's insignificant. I'm talking about a closing above 103 in a more significant chart, such as the 15, the 30, the hourly, etc., etc. What do you know? The dollar gets above 103 momentarily, but then it loses 103 as support and it becomes clear the dollar is not going to make it, and down it goes. What does that mean? The rally will continue, but do we go with the Qs? Do we go with the IWM? Do we go with energy, for example? 6:33 a.m., 3 minutes after the bell, I say SLB, CVX, VLO. I'm playing the dollar moving down by going long energy, even if it is for day trades, doesn't matter. And then around 7 a.m., I say Dixie can't make it above 103 and stay there, sticking with energy here. And then guess what happens? Energy takes the lead, closing at number one and capturing the gold medal. Boom. And that leads us to a conversation that we talked about a few videos ago when I said, hey, warning, the Fed cannot cut rates even if they wanted to, because the Fed cannot afford to see the dollar going down. So the Fed doesn't like what happened today, and the Fed might fight it in an attempt to revive the dollar. But Jerome Powell is not going to speak until, a few weeks from now? In the meantime, if the dollar continues to go down, guess what's going to happen? It will be the revival of the energy trade. Oil prices will move higher again. Natural gas prices will move higher again. And that's inflationary. So the morons celebrating the drop in the CPI by 0.1%? Meanwhile, inflation, even with the cooked data, at 6.5%, which is historically high, and crushing to the economy and the consumer spending power, which is recessionary. But I say the drop in the CPI is a double-edged sword because on one hand, you say inflation is going down, the Fed doesn't have to be as aggressive, and higher we go in the equities market, we have a soft landing, no loss of jobs, at least a significant one, yada, yada, yada. The problem is the conditions for a rebound and a revival in inflation are still here. Because guess what happens when inflation goes down, when prices go down, and folks still have their jobs, they still have their inflated salaries? What do you think will happen? A law called the aggregate demand will kick in. The consumer will start splurging again, especially if they get the green light by the Fed that the Fed is backing off. No more interest rate hikes. What does that mean? We go back to swiping those credit cards up and down, up and down, up and down, and splurging in the economy. And the dollar goes down. Commodities move higher in price, and here we go. We have inflation coming back, better, stronger, and with more veracity. And then the Fed realizes they made a mistake, whoops, and they have to come back at it with more aggression, and that will be destructive to the economy. We'll take it one step at a time, because we have no idea how the Fed is going to fight this. The Fed wants to keep the dollar propped up because this is their best insurance policy against inflation rebounding. So are they going to come out right away by sending Bullard or Harker or Kashkari to knock some sense into the market? They could do that, but I cannot guarantee that the market is going to listen. The market is only going to listen when the FOMC comes out and Jerome Powell comes out with the hammer. But until then, if the conditions we've seen today continue, we will see the dollar continuing to go down. The impact will be inflationary, which will push energy prices higher, and that makes the revival of the energy trade. And with this intro out of the way, let's get right into it. And here it is, in focus tonight. Be careful what you wish for. You might just get it. You want the Fed to ease? At least you want to assume that they're going to ease and back off. The dollar goes down, inflation goes higher. And it becomes a lose-lose kind of game. The number we got today from the cooks at the Bureau, the CPI, 6.5% year over year in December, and it stands at 5.7% if we take the non-important food, energy, and perhaps oxygen too. Yet the most important number we pay attention to is the month-over-month reading. And the month-over-month reading for the CPI, all in all, down 0.1%, and less food and energy, it was actually up by 0.3%. And as you can see, the categories that went higher month-over-month, gas services up 3% since November, thank you to the state of California and our beloved governor, Kim Jong-un Newsom. Hospital services up, meats, poultry, fish, eggs, that's up, electricity, motor vehicle repairs, rent, that's up too. So did insurance, apparel, alcoholic beverages, non-alcoholic beverages, medical care commodities, in addition to physician services, while cereal and bakery products were pretty much flattish month over month. What went down in price month over month, new vehicles, tobacco and smoking products, dairy, fruits, vegetables, used cars, airline fares. That doesn't make sense at all. We covered that in details in last night's video. In any case, gasoline down along with fuel oil, which led the declines month over month. What is the reaction by the Fed? Take, for example, the St. Louis Fed President Jim Blaze, who came out and said that the Federal Reserve's front-loading strategy, interest rate hikes last year, was a success and should be continued. Whoops. He also added, we're moving into an era of higher nominal interest rates for quite a while. And here's what I got to say about this. The Fed versus the market continues. The market continues to say that the Fed is bluffing. They're not going to really raise interest rates. They're not going to be higher for longer. They're not going to pause and hold. They're going to actually cut rates, whether they like it or not. The market continues to fight the Fed. Of course, the Fed is going to win at the end of the day, but the fight between the market and the Fed will prove to be disastrous because as the market continues to fight the Fed, by rallying higher, including the stupid meme stocks and the mania, cryptos, tulips, crap, what do you think will happen? Financial conditions will loosen more, the dollar is going to get crushed more, commodities will appreciate in price more, and then the Fed will have to come back with more aggression, not less. In the meantime, how do we play this rally? And this is, of course, in my opinion, do your own research and take whatever steps you deem appropriate. But for me, the New Year rally has 3 stages. Stage number 1, Now, I've been talking about this for a while now. Stage number 1 will be led by small caps, high beta, low quality leadership. We're talking about the IWM, Bed Bath & Beyond, AMC, Carvana, GameStop, RKK, the trash kind of names. And they've been blasting significantly higher. Now, I think we're done with this stage and we're moving to stage number 2 because we now have a confirmation that the dollar indeed broke an important and critical support. You can play this in many ways. You can chase the rally in metals, for example. You can chase the rally in cryptos if you want, but the way I'm playing it is via the energy leadership, which I believe this stage started today. As the dollar continues to go down, energy moves higher. We'll cover a lot of energy charts in a minute, but stage number 3, which will mark the end of this rally, the rotation to value, aka last year's winners. So in stage 3, we see the names that are being dumped right now, such as Big Pharma, the defense contractors, defensives, utilities, even some of the real estate names taking the leadership. And when you notice and you see that happening, you know that the bear market rally is ending. But another important sign to the end of the bear market rally is, most importantly, of course, the change in sentiment. Because heading into this year, everybody and their mothers became bears. All of a sudden, of course. I've been bearish when everybody was bullish and got it right. Now, all of a sudden, these strategists and so-called experts, they got caught with their pants down. They lost an insane amount of money last year. They lost their clients, most importantly, an insane amount of money. They're embarrassed about it. So they became bearish all of a sudden. We head into this year with extreme bearishness across the board. What do you know? The market rallies higher instead. So the Johnny-come-lately bears all of a sudden embarrassed because the moment they change their sentiment, the market goes the other way. So what's going to happen now? With the reading of the CPI, with the dollar going down, with the yields going down, with the SPY, the Qs, the IWM, the rest of them all moving higher, with the revival of the meme stock mania, with perhaps more significant technical breakouts. We talked about the sloping line of resistance in the SPX, the S&P 500, and if that's broken to the upside, everybody and their mothers will become bullish again. You're going to start to see Tom Lee on TV every single day. You're going to start to read the comments on this channel saying, hey, Maverick, you're wrong. You're a perma bear. You missed the bottom. The bull market is back. Then you know that they're going to pull the rug and the bear market resumes. Now, heed this warning. I say that we're seeing the revival of the energy trade and the revival of inflation because the dollar is down. It's going to take a while till the Fed comes out and knocks some sense into the market, that they cannot afford to watch the dollar collapsing because this will push commodities higher. But until then, energy takes the lead if the dollar continues to go down and the Fed fails to knock some sense into the market. However, pay attention now. If the Fed indeed succeeds in rescuing the dollar by sending Kashkari out or Williams or Daly or whoever zombie they want to send, and the market ends up listening to what the Fed is saying, the dollar is going to rebound higher, energy will go down. But absent of this scenario, the market is now not listening to the Fed at all. And if that is the case, dollar goes down, energy takes the lead, forget about technology, that is a bull trap. So let's look at some energy charts here, and we start with the strong and we end with the weak. Now, here's a strong looking chart, the ticker HES for Hess Corporation. And I tweeted this, discorded this today. Look at the weekly chart, we have a bull flag pattern that is breaking out. It is making higher highs. In other words, HES is looking good right now. If the dollar continues to go down, higher it goes. Another decent looking chart is SLB. I've been long this name for a while now. And it is breaking out. It was in consolidation pattern. This is a weekly chart, of course. And then it became a bull flag consolidation pattern. And now the name's breaking out. Now, at some point, SLB will face overbought conditions in the weekly and move down in a pullback. But for now, the chart looks strong and the chart is breaking out. Another good-looking chart is HAL Halliburton. Weekly chart moving higher, making higher lows, maintaining the pattern. It did fill the gap this week. And it is facing the prior high. This will be resistance for now. And if the name cracks above it and closes the week above it, most importantly, then we have a bullish sign, a buy sign, because HAL is making new highs. Another strong-looking chart, perhaps not as strong as SLB and HAL, is VLO Valero. We talked about this chart before, a weekly chart. And perhaps we're seeing the formation of a cup and handle, and if it is, then sooner or later VLO cracks above the sloping line of resistance, making a new high. Then we have another chart looking good, not bad at all. Weekly chart for CVX Chevron. It is in a consolidation pattern. It is now facing the prior high. It did close above it before, but it's going down to seek some more support. And if it does, and it moves higher, making a new high, that would be a buy signal because CVX will continue on the bullish momentum. The bullish trend is still intact here. Now, another way we can look at the weekly chart for CVX is, what if this is a cup and handle formation in the making? If it is, it breaks higher, and we make higher highs in this chart. Now, here's another one, perhaps not strong, maybe a little weak here. PXD for Pioneer Natural Resources. It had a trend, a bullish trend, and it broke it before, at least twice, but it is fighting back. Now, if it wins and earns a place back into the consolidation pattern, then the likelihood becomes the name will crack above the resistance, the top of the consolidation pattern, and make a new high. Last but not least, a natural gas play, EQT weekly chart looking weak because we have a rolling top pattern, and it broke an important support line of 35, but it is fighting back. Look at the RSI and MACD indicators. We're seeing the negative momentum sort of bottoming for now. And if this continues, and we see EQT breaking above this rolling top, saucer topping formation, and most importantly, recapturing 35 on weekly basis, then we do have a reversal on hand and EQT moves higher. I don't know if it's going to make a higher high, but it could be worth playing some upside here. Anyhow, this is my 2 cents. If the Fed fails to rescue the dollar all the way till the FOMC, then higher we go, and the rally will be led by energy. Now, do your own research. Don't take my word for it. Otherwise, you might end up losing all of your money. With that being said, let's move on to the coverage of the stock market, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average in the green by 216.96 points, or a gain of 0.64%. The Nasdaq also positive for the day by 69.43 points, or a gain of yet again 0.64%. The S&P closing positive by 13.56 points, or a gain of 0.34%. When we take another look at the sector's performances today, number 1 capturing the gold medal, energy. Number 2 for the silver, materials. Number 3 for the bronze, real estate. Meanwhile, the laggards for the day, once again, the recession-themed plays, consumer defensives, utilities, and healthcare. But mind you, I keep saying this over and over and over again. They will make a comeback. And as an investor, you want to be in these names, not chasing the rally in tech, small caps, the trash kind of names, RKKs, etc., etc. Now, when we look at the market breadth, the NYSE 75% advancing versus 24% declining. The Nasdaq 69% advancing versus 29% declining. As of late, the breadth has been really good, but is it peaking? I think we're getting there. When we look at commodities, the dollar went down big in reaction to the CPI, and therefore we have a revival in commodities across the board. Energy up, softs up, even coffee up today. Metals, grains, all in the green today. Although we have some few exceptions here, cotton futures and softs were down big, almost 3% for the day. We also have some weakness here in meats, flattish for the day to negative, along with certain metals such as copper, platinum, palladium, but specifically copper, which has been rallying ahead of time. So perhaps in copper we have the phenomenon of buy the rumor, sell the news. When it comes to currencies, once again, the notable action is the massive upside that we saw today in the Japanese yen. The only recessionary theme in play today. Yen goes higher, dollar goes down, along with the CPI pressure, a lot of downside momentum for the dollar today. And if it does continue, we will see the rally in commodities also continuing all the way until the Fed puts an end to it by rescuing the US dollar. On to the big casino, the options market. What do we see here? The volume continues to go down, yet the put-to-call ratio remains in favor of puts right now. So we see the options market not buying the rally, being skeptical here, actually buying more puts, betting for a pullback. Yet the all-in-all volume is not as significant as it used to be before, let's say in the month of December. So the question becomes, are options traders betting for a pullback, or are options traders fighting the move right now? So we have a market that is fighting the Fed, and we have traders who are fighting the market, betting that the Fed will put an end to it. But the question becomes when? Is it going to happen tomorrow by Neil Kashkari? Is it going to happen the day after by whoever zombie they send? Or is it not going to happen all the way until the next FOMC? If that is the case, the rally might pull back, but it will continue to go on. We might see rotations, change in leadership, but all in all, without the Fed coming out aggressive and putting an end to this rally, it shall continue. But here it is in the casino, number one, the hottest table by far, Tesla, with around 1.7 million contracts traded today. Once again, puts outweighing calls, this time around by about 57%. And then we have the hottest stock in town, BBBY, Bed Bath & Beyond, bankruptcy optimism moving the stock higher significantly. And today the volume was exceedingly high at around 1.2 million contracts. About 66% of those were calls, not puts. Folks are playing more upside in Bed Bath & Beyond. Here's the problem. The IV rank, the implied volatility, is reaching extreme levels, the highest in a year. Now what does that mean? It means that call options are becoming really, really expensive. The stock has to move by 50% a day for you to make your buck buying these calls. I don't like these kind of Johnny-come-lately trades. I bought BBBY before the move, and I got rid of it along with AMC yesterday. So I missed on the move today, but it doesn't matter. Calls are getting really, really expensive. You gotta book your gains, and the best way you can play this right now, watch for a reversal signal, and you're better off buying puts than calls. But mind you, it could be painful if you're speculating and betting that this is gonna be the day or Bed Bath & Beyond moves down. You gotta wait for a confirmation, although we're getting really, really close. Next, we have Amazon at number 3 with around 1.2 million contracts traded today. Once again, puts outweighing calls, this time around by about 54.5%. When we talk about the unusual activities that took place in the options market today, what about BA Alibaba? The name is moving down in the last few days. Is it time to short? It did not reach my threshold. But perhaps it is the time, at least according to this trader who bought the 105 puts, all for the expiration date of January 27th, with expectations that BA could move down and lose more than 7% of its value by then. They paid around $1.40 a piece to enter this trade, all in all spending around $1 million. And then we have a couple of trades for the IWM. We have a call one, we have a put one, pick whatever you want, but I hate this kind of Johnny-come-lately moves. I bought the IWM before the move, and I've been talking about it before the move. I've been saying in chasing this rally, you want to go with the IWM small caps, not the Qs, not the Dow Jones, because Russell 2000 will be the outperformer. Indeed it was. But now I'm out, and perhaps it is the time to get out and bet the other way, because we have this trader who bought the 167 puts with the expiration date March 31, with expectations that the Russell 2000 will move down and lose more than 10% of its value by then. They paid around $2.10 a piece to enter this trade, all in all spending around $1.3 million. And then they're fading the rep across the board, at least the options traders here. This time around for the Qs, somebody bought the 261 puts with the expiration date February 24, with expectations that the Qs could move down and lose more than 6% of its value by then. They paid around $3 a piece to enter this trade, all in all spending around $1.8 million. And last but not least, what about the SPY? Also fading the rep this time around, buying the 370 puts with the expiration date February 24th, with expectations that the SPY could lose more than 7% of its value by then. They paid around $2.20 a piece to enter this trade, all in all spending around $770,000. On to the heat map analysis. What do we see here? A continuation of the same theme year to date, which is buy the losers, dump the winners from last year. We see names such as Big Pharma lagging along with the defense contractors, the consumer defensives, all in the red for the day. What's leading the pack this time around? Once again, chips, the trash kind of names, meme stocks, Meta, the technology cohort, but they're kind of losing momentum here. And perhaps we're seeing some rotation out of the recent winners all the way back into energy. And if I'm right, energy will take the lead from this point on. Now, the only significant piece of news that we got today is regarding Disney. The name was up today, but be careful here because this is becoming a battlefield. We have a rebellion by Nelson Peltz who wants to see some changes. He's an activist now. He wants to see some changes in Disney. He wants to cut the fat, make it leaner, more profitable so he can make more money. The problem is he's going against another egotistic maniac in Bob Iger, and you really don't want to go against Bob Iger in his own house. Now, the thing about Nelson Peltz is, dude, you're 80 years old. You got one foot in the grave, and you're still doing activist investing. You're still looking at stocks every single day instead of going out, playing golf, enjoying the sunshine before you say goodbye? What motivates people like Nelson Peltz at this point? You're already a billionaire, you're 80 years old, and you're still playing the stock market? What motivates somebody like Nelson Peltz at this point? He's already a billionaire. I mean, ego? Gobbling up more money? I don't understand this. At this stage of life, you should be enjoying your life, the sunshine, the bucket list, maybe spend your money to create some legacy, leave something to humanity. But of course, ego and greed never dies. They want to gobble up more and more and more until the last minute. And believe it or not, some of them actually believe that they're going to live forever. Some of them actually believe that, yeah, I'm at 85, but I'm going to make it till 120. I'm never going to die. Some of them actually believe that. Now, when it comes to Disney, does it have problems? The answer is yes. To begin with, it is a conglomerate. And as an investor, if I'm investing in a diversified company such as Disney with parks, streaming, TV, media, other endeavors, I'd like to see a big fat dividend, and Disney's not making that. So I'm not interested here. And if the company is going to become lean, what are you going to cut? ESPN? That's a profit-making machine, but it is declining. The parks? The only thing Nelson Peltz would do is increasing ticket prices even higher. Is he going to cut the streaming budget, for example? We have no idea. And as I've said, Disney has a lot of problems, but we have no idea what Nelson Peltz wants to see. We have no idea what Bob Iger wants to see. And as these two assholes go at it, I say pass the popcorn, and I'm going to take a pass on Disney. Now, what do we see in the heat map for the ETFs? The laggards, once again, the winners of last year, the recession types such as the XLP, Consumer Defensives, XLU, Utilities, XLV, Healthcare. But interestingly, the winners are no longer the growth types, the risk-on types. In the last few days, we have seen XLK, chips, even the cyclicals and the XLY leading the pack. Today, we have a leadership rotation from these sectors all the way back into energy. We see the XLE, XOP, OIH all leading the pack. Of course, we have the winner in the XBI, biotech, but we have certain news for certain names within the XBI that moved the ETF all in all significantly higher. Now, isn't the rotation interesting, and how long will it last? If I'm right, it's going to last for a little while. We will see a pullback in the technology chips that led the way in the last few days. We see energy taking the lead this time around. Yet we have more signals that the recession theme is in play, but we have a delay, which is giving you the opportunity in the XLP, XLU, and the XLV. These indicators, including the TLT, which continues to move higher. Buying bonds is recessionary because it is the ultra safety. For now, bond yields are going down because they're expecting the Fed to be less aggressive, but at some point, yields will also go down because the economy is deteriorating. That's number one. Number two, gold, GDX gold miners, a recession type of play, also continues to lead the pack. So we have some signals here that the recession plays will be back in play, and the talent becomes picking the laggards. For example, in the last few days, we have seen GameStop, Bed Bath & Beyond, the meme stocks moving higher. But absent from that rally was AMC. And I looked at that and said, wait a minute here. If all of them are rallying, why couldn't AMC rally? And I did buy call options. And those options, when AMC popped higher yesterday, appreciated by over 300% in a single day. Similar story here. The recession plays TLT, GDX, they're going higher. Absent from the rally, XLP, XLU, XLV. And this is where I see the opportunity. The problem is the timing becomes really tricky. On to charts, we begin with the SPY, the S&P 500 30 minutes chart. What do we see here? The ABC pattern now beyond completion. It got exactly to the target that I've been looking at, 398. Now what happens? I believe it's going to stall here. It doesn't mean it is a reversal. It is a shorting signal. I'm not saying any of that. I'm saying it is a good point to book some of your profits if you've been playing this rally from the get-go. For one thing, 398 is stiff resistance. Number two, we have negative divergence on the RSI, so we're seeing relative weakness here. In other words, the SPY could move down in a retest, let's say to 393.16 or even 391, or even all the way to closing the gap below. Even if that happens, does it change the bullish outlook on the daily chart? The answer is not quite. For now, the chart is above an important resistance at support at 3,960. The bulls have been eyeing 4,000. They got to 4,000. Are they going to close the week above 4,000 or not? Because it becomes an important sentiment pulse. At closing above 4,000, major win for the bulls. They move higher from this point on. At closing below 4,000, and now the bears are going to become excited again, and they will wake up from hibernation. But for now, you look at the RSI, you look at the MACD, any signal, any indicator here that this rally is reversing, the answer is not quite. You look at the volume moved higher on an upside day. So we're not seeing any signal here of a reversal, or more importantly, a shorting signal. We might get one, but we have to wait for it. Because here is the weekly chart for the SPX, the cash index. It is now dabbling with cracking above an important resistance line, the sloping line that has been going on since 2022, aka the start of this bear market. My most bullish outlook is the bulls crack above this line and they rally even all the way to 4,325.28. And if that happens, the moment we close the week above this sloping line, you're going to see the sentiment changing across the board. You're going to see Tom Lee every single day on TV saying higher we go, we close the S&P higher by 25%. The problem is the underlying conditions in this bear market, forget about the technicals, are still here. And the Fed might make the mistake in the short run by listening to the pressure and moving down to reducing the pace of interest rate hikes to 25 basis points or perhaps pausing altogether. That will be a major mistake. But in the meantime, it's going to push the chart all the way to my target of 4,325. And then we see the Fed pulling the rug, coming from behind, playing catch up because they now realize that the dollar went down too big and that enabled commodities to rise higher, and therefore we're seeing inflation moving higher again. That is scenario number one, and it is gathering a lot of steam as of late. Scenario number two is this rally is too much already for the Fed, and they will say something drastic to stop the market rally, perhaps exactly at the sloping line of resistance, and we see the SPX stalling and moving down again. What will it take for the Fed to fight the market and beat it at this point? The answer is if they come out and say, hey, are you assuming that in the next FOMC we will do 25 basis points? That's not going to happen. We will do 50 basis points because we're front loading. If all of them say that, Harker, Kashkari, Barkin, all of the zombies, then maybe that will play out. But make no mistake, the Fed is facing a lot of pressure right now. You heard Senator Warren, for example, and the other lunatics in government. If the Fed, despite this data, says, okay, we're going back to 50 basis points instead of 25, they will face a lot of pushback. So my hunch is scenario number one will be at play. The Fed is going to wimp out. They're going to do the 25 basis points and then pause. The dollar is going to get crushed. Commodities will move higher. In the meantime, the SPX will move above the sloping line of resistance, and then we have a revisit to the battle against inflation, and we see a rug pull, and down we go in the SPX. What about the Qs? 30 minutes chart, what do we see here? The ABC pattern is now beyond completion. It got all the way to my target of 280, which is stiff resistance. I don't believe that the Qs will be able to crack above 280 easily. In other words, we have a negative divergence on the RSI. I would not be surprised if I see the Qs down tomorrow. But the question becomes, does it change anything at all in the daily chart for the continuous contract for the NASDAQ? The answer is not at all. The volume is higher on a buy day. That's a positive signal, bullish signal. The RSI, the MACD indicators firming higher. That's also bullish. The chart is above the important number of 11,058.5. We have no reversal signal at all. Most importantly, we have no shorting signal at all for now. We might get one, but it will require a fundamental piece of news, in this case, something from the Fed, to pause and move this rally down again. IWM, 30 minutes chart, what do we see here? It remains the outperformer, beating the SPY, beating the Qs, beating the Dow Jones, and it is now above an important support line, 183. It is eyeing the next resistance line, but before that, we have another resistance, perhaps the chart is already at it. And this coincides with the top of another rejection candle. We're now at the same place. So my hunch is, with the chart being overbought, facing an important rejection here, we could see the IWM pulling back tomorrow. So keep that in mind. But it doesn't change anything at all until we see a loss of 183. And most importantly, loss of the gap below that. And then even if that happens, all what we're going to see is a pullback, not a reversal, until the IWM loses 174.22 for good. The Dixie, the dollar index, what's going on here? It was hugging 103, forming a bear flag pattern. And the Dixie was waiting for the CPI. If it is hotter, we see a major pop, a major short covering in the dollar. But if it doesn't, and today was plain vanilla, it met expectations, 6.5%. And the talk is the Fed will go down to 25 instead of 50. So the dollar flushes down, the bear flag plays out. It loses 103 as support, and it closes the day below this number. For now, as I see it, you look at the MACD, you look at the RSI, we have all confirmations that the dollar is eyeing the next support at 99.89. Now, look, anything could happen here. It could be a knee-jerk reaction that we got today. The Fed could come out tomorrow and fix this and push the dollar above 103 again. But folks, I cannot predict that. All what I have to do is play with the chart right in front of me. And looking at the chart right now says Dixie goes down. What happens if the Dixie goes down? Gold goes higher. And gold, with a massive blast today, closing above my number of 1,895. Am I going to chase this? Am I convinced now that gold is in a bull rally and it's going to continue higher? Maybe, but I think I'm Johnny-come-lately here. And I hate being Johnny-come-lately. I hate chasing things. I want them to see go down at a better point and then I'm going to hop in. So I'm not chasing gold. If you want to do that, have at it, my friends. I think I will have a better entry point here. I'd rather chase energy at this point because it has been lagging. I'm not a Johnny-come-lately to the energy trade here. If anything, it looked as it's going to lose 77 as support, the important number, and down it goes. But now with the dollar going down, what are we seeing in the daily chart of UK oil, Brent oil? We're seeing a higher low. Now, do we have the confirmation that the rally goes on? Not yet. But if we have a closing above 85, most importantly, making a higher high in this pattern, that we have the confirmation that UK oil will move significantly higher. We play that by individual stocks. We covered many charts in the In Focus segment for you. On to the 10-year yield, the daily chart. What do we see here? The bear flag pattern played out. It was acting exactly as the US dollar, hugging the important support of 3.5, waiting for the CPI to give it the confirmation, either to close above this support or to rebound and pop significantly higher in a counter-trend rally. Well, we know what the answer is for now. The 10-year yield lost an important support, 3.5. The bear flag played out. And what the 10-year is saying right now is the Fed is going to move from 50 basis points to 25, and it is getting closer to ending its tightening campaign. I have a hunch, folks. I've watched this movie before many times. Everybody's going to feel safe. Inflation is over. We have the soft landing at hand. The bears were wrong, etc., etc. Then what happens? Dollar goes down. That's inflationary. It moves commodities higher in price. The 10-year yield goes down. What is that? That is inflationary. We see housing prices rebounding higher again. And we have the underlying conditions, with the employment market being intact for now, that inflation will make a rebound. I told you before, just like back in the 70s, there is no such thing as inflation popping higher and then it nosedives right away back where it came from. It never happened like this before. What we see usually is inflation pops higher. We see a response by the government or the Fed. Inflation goes down, then the government / the Fed becomes too comfortable and says, okay, we declare win against inflation. Then what do you know? Inflation pops higher again. And then the Fed realizes that and start fighting inflation once again by tightening the monetary policy once again. The problem is, at that time, the Fed will be playing with both hands tied behind their back. So the disciplined thing to do, the Volcker thing to do, is to stick with the tightening campaign right now, regardless of the crybabies, regardless of the whining and the wheezing and the bitching and moaning by the stock market. It doesn't matter. But again, folks, my hunch is the Fed will make the mistake, inflation will come back, and we will revisit this fight once again. We'll see what happens, but for now, with the charts right in front of us, the way they look right now, the TLT is moving higher. I'll be waiting for the TLT to crack above 109.5, recaptures that as support, and then I'm in. The VIX 4 hours chart, another confirmation that the rally goes on this time around, breaking the important support of 20. Again, make everybody feel comfortable. Make the bulls come back. Make Tom Lee come back. Make everybody say, hey Maverick, you're a perma bear. You're wrong. And then the rug gets pulled. This is the beauty of playing the stock market, folks. You gotta be patient. You gotta trade what you have right now. But you gotta invest based on what you see in the future. And what I see in the future, a revival of inflation and the Fed coming back with the fight, which will cause a severe recession in the economy. Apple, 30 minutes chart, what do we see here? The ABC pattern complete, got us all the way to the target of 134.37. And now what? It is stalling in a bullish consolidation pattern, waiting for buyers to crack above the important resistance of 134.37. But it moved too high, too fast in a short amount of time. Would I be surprised to see Apple moving down in a retest of the support line once again tomorrow? The answer is I would not be surprised at all. But does it mean that we have a shorting signal for Apple? The answer is not quite. Not until the chart closes below the important support, preferably for the week. We'll look at Tesla 30 minutes chart, again, consolidating within a pattern, but still making higher lows. So long as it continues to make higher lows, the assumption is it's going to crack above an important resistance at around 128.62. And if that happens, we could see some capitulation by the shorts. They start to cover ahead of earnings, and we see Tesla moving even higher. Last but not least, what about Bitcoin? Massive move higher in a risk-on rally, but look at the RSI. It is getting way ahead of itself. It is getting overbought for now. We could see a trap and Bitcoin moving down in a pullback. I'm not going to say that Bitcoin is out of the woods until it closes the week above 20,593.34. Absent of that, you can chase the rally, you can trade it, you can play it in short run, but I wouldn't say that Bitcoin is out of the woods. Now the question becomes, so do we short Bitcoin? Do we use the pop as an opportunity to short? The answer is, you got to see one or two things. You got to see either number one, Bitcoin moving down right away and making a new low in the pattern, or you got to wait for a reversal candle, a loss in momentum in the RSI and the MACD. For now, we don't have any of these two. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the import price index. We also have from the University of Michigan, the consumer sentiment index, along with consumer inflation expectations. But most importantly, we have a bunch of Fed zombies speaking. The most important one is Neil Kashkari because he's been talking hawkish as of late, saying, you know what, I'll show you. The market wants to fight the Fed, I'll show you. We'll beat you. Now, is he going to backtrack after the CPI that we got today? This is what I'm watching for. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again over the weekend. Have a good one. Take care.
I beg pardon? I said enjoy your lunch and we'll try to enjoy ours.
Well, why don't you try and enjoy it elsewhere? Are you friends of his?
Did I get a chance to introduce my associates,
No,
Daniel?
you didn't, and I don't think you need to take that chance. Gentlemen, are you a friend of his? You work for Standard?
Yes.
Oh,